Financing a manufactured home on lease land, how is that different than traditional house?
These are not real property. It's almost like a car where they have a year, a model, and that sort of thing. And they're all in mobile home parks where they traditionally don't own the land. They're paying space rent to the actual park where the unit resides. There's two approvals, one with us and also with the park.
So you may qualify for a loan and may not qualify for the park, or you may be buying it in cash and say, hey, as long as I buy it in cash, then I'm good. The park has its own separate approval process.
There's a special date that we reference here with mobile homes, June 15th, 1976. If it's built prior to June 15th, 1976, a lot of lenders won't even touch it.
Manufactured homes are becoming a little bit more popular as an affordable option to be able to stay in California. Today, we're diving into one of the most misunderstood areas of real estate financing, manufactured homes on lease lands or mobile home on lease land. A lot of buyers assume that financing a manufactured home is the same thing as financing a traditional house, but it's far from the truth. Park approvals, lender restrictions, down payments, interest rates, insurance requirements, resale challenges. There's a lot of moving parts, and buyers, sellers, and agents and investors need to understand. So today we're bringing an expert to break down exactly how financing works on manufactured homes or mobile homes on lease land communities. We've got Michael Yates, a return guest. Welcome back to the podcast, Michael. How are you?
Good, Jose. Thanks for having me again.
Let's talk about financing a manufactured home on lease land. How is that different than financing a traditional house?
These are not real property. It's almost like a car where they have a year, a model, and that sort of thing. And they're all in mobile home parks where they traditionally don't own the land. So they're normally hearing the term space rent or lease land. So they're paying space rent to the actual park where the unit resides. And so it's not like traditional financing where they own the land for the most part.
How is the financing differently? Meaning, is it traditional financing is like a 30-year fixed loan? Is it the same in a manufacturer world? How does the interest rates compare to a traditional house? Are they higher? Are they lower? How does the qualification differ? Is it easier to qualify for a house? Is it easier to qualify for a manufactured home?
So it's actually very similar to traditional financing except for a few different things. So the terms are normally going to be a little shorter, whether it's a 25-year fixed or a 20-year fixed. We have both of those options. Interest rates are normally going to start in the mid-8s on these compared to like mid-6s if it was traditional financing. So those are the biggest things where it's a little shorter term, and then it's a little higher interest rate on those. But as far as qualifying goes, very similar to traditional financing where you're looking at W-2 income for the past 2 years, debt to income ratio caps around 45 for one investor, 50% for others. So it will vary from investor or bank that you work with on those, but very similar to traditional financing with those two little differences on the rate and the term in most cases.
Got it. Okay, so a little bit higher than traditional financing for the interest rate and a little bit shorter term. For our viewers that don't understand that, a lot of houses are 30-year fix. It might be 20-year fix or a 25-year fix, which means it's paid off in a shorter amount of time, which means the monthly payment could be a little bit higher because it's a shorter term as well, too.
Correct. At the same time, you actually have a little more money go towards principal as well, so it's not a bad thing.
In some cases, not working with your company, but I had heard other lenders that will do a 10-year term or 15-year term. So depending on which lender you're working with, the term could vary.
And we actually do have a 10-year or 15-year as well. It's obviously a higher payment, like you need like a car term. If you're doing a car payment over a 3-year term versus a 5-year term, much higher payment on that 3-year term versus 5 years. So we do have those options as well. A little better interest rate. It might be closer to high 7s, 8% give or take on those. But yeah, we do have those options as well.
So I guess it just depends on how fast you want to pay off the loan.
Correct. And also the buyer's comfort level on the payment is the main thing that we come across.
Now, I think one of the unique things about your company is that you guys actually offer both manufactured home financing, but you offer traditional financing as well too, right?
Correct. Yeah, that's a huge advantage as far as working with someone like myself where sometimes when you're talking to a mobile home lender, they just do mobile homes. And so if you get pre-approved, then you end up wanting to go buy a condo or a townhouse or something else down the road. You're really kind of out of luck with them. Where if you get pre-approved with us, we'll get you pre-approved for the mobile home. And if plans change, you need to buy something else, we have access to traditional financing with conventional loans, FHA, VA, everything across the board. So it's a huge advantage, one-stop shop, and we can kind of cover both.
And that's one of the things that I love about your guys' company is that you offer both, because like you said, with a mobile home lender, they only offer the mobile home financing, which means that if you decide not to buy a mobile home, then you got to go to a different lender. And at times they ran your credit already. So just keeping it all in-house would be good. Now, a big misunderstanding on a manufactured home is the financing, but then there's a space rent. Can you tell us what space rent is, or the Lease-Land? What is that, and how does it affect the financing?
So on top of your mortgage payment, there's always homeowner's insurance. Some have a small little property tax bill, but the space rent is actually rent you pay to the park. And that will vary from location to location. I've seen space rent as low as $500 per month. I've seen it as high as $2,100 per month. In most cases, they are covering some utilities for you, like water, trash, cable. So, always check out the fine print. There should be some information your agent should get for you on that. So they do cover some utilities, but definitely it's a huge range on space rent out there. That will affect your debt to income ratio. When someone's looking at different parks and they're saying, hey, do I qualify for $200,000 with this space rent? It might be yes, but if you go with a higher space rent somewhere else, it could be no. So we always got to factor that in when we're looking at someone's qualifications when it comes to the debt to income ratio.
I think that's really important for them to factor in, because whenever we have manufactured homes for sale, we'll get inquiries and they'll be like, oh, I can buy it in cash. But in some cases, they don't realize that, hey, look, there's still a $2,000 a month space rent for the Lease-Land, or $1,000 a month.
Yeah.
Not only that, but whenever you're qualifying for the loan counts that space rent into your debt to income ratios as well, too, I would imagine.
Correct. Yeah, we definitely take that into account because it's the full picture. It's like someone buying a condo with HOA dues. We have to take that into account. There's also, you kind of touched us on this earlier, the park approvals. The park actually has to do their own approval for each buyer. They're looking at the income, and sometimes their qualifications I've seen are tougher than ours, where they want to see 3 times the space rent or 3 times the mortgage payment as far as income versus the payment for qualifying on their end. So normally that happens pretty fast in the process. Sometimes they'll have you do that before they actually have an accepted offer, just so they don't go into under contract and they have issues down the road on that. So keep that in mind. There's 2 approvals, one with us and also with the park.
Yeah, so you may qualify for a loan and may not qualify for the park, or you may be buying it in cash and say, hey, as long as I buy it in cash, then I'm good. The park has its own separate approval process that they go through. What about the down payments? How are those different than a traditional house?
Yeah, so there's really not any kind of down payment assistance programs that I've come across on these, but I do have a excellent lender that we work with all the time. They will do it with as little as 5% down. They can go down to a 600 FICO score on that with 5% down. And they will also let someone finance all closing costs, which is a huge, huge advantage. I've never even heard of it before until this company. So for example, say someone's buying a house for $200,000 and 5% down is $10,000. Closing costs, let's call it $10,000. So in most cases, they would need to come in with $20,000 for between the down payment and the closing cost. With this situation, if they finance the closing cost, we would tack on that $10,000. So then they're bringing in 5% of $210,000, which is $10,500 out of pocket versus $20,000. They're financing a little bit more. You don't have to do that, but everyone that, I would say 95% of people we work with on this program take advantage of that, because when you buy a new house, as you know, when you're moving in, there's always certain things, you have to get new furniture, slab breaks, new flooring. So it's nice to have a little extra cash in the pocket and finance the closing cost on that.
Amazing. Now, how does the age of the manufactured home affect the financing, if anything at all?
There's a special date that we reference here with mobile homes. It's June 15th, 1976. So that's a date that HUD put out there where there was extra safety requirements that were required in mobile homes after June 15th, 1976. So as long as the coach is built after that date, we don't really have any restrictions. We can do the 5% down and however, they want to slice or dice their financing. If it's built prior to June 15th, 1976, a lot of lenders won't even touch it. I have one bank that will do it. They do require 30% down on those units, and it cannot be a single wide, it must be a double wide. So I'm not sure what other investors or banks have on that requirement for the pre-1976 date, but we do have one option, and it's nice to have that to play with.
Well, even 5% down is excellent, to be quite honest, because with other companies, what I had heard is if it's newer, then they'll do 5% down. But even if it's newer than 1976, but let's say older than 2000, they may require 10, 15% down versus just the 5% down overall. Mm-hmm. And I think this is something for our viewers to be aware of, that the down payment can depend on the year that it's built. Like you said, if it's older than 1976, June 15, 1976, it could be as much as 30% down, but that's something that could vary lender by lender, basically. So it's not something that's set in stone.
Yeah, correct. And then a couple of good things I'll kind of add on this with this program too. Like I said, we can do the 5% down to 600, but my investor with this will actually average out the two borrowers' credit scores. So I've had a couple of cases where someone had a 740 FICO score and the other person had a 619 FICO score. We were actually able to use their 740 score for their pricing and their rate. It was amazing. So that was something that was a huge advantage for us here. And then also we can do this with ITIN borrowers. And even if you don't really have the ITIN, but you have your work permit and you've been working for a couple of years at your same employer, we've had those go through as long as it makes sense. These lenders will really work with the buyers on these types of programs.
That's amazing right there. Got it. Okay. And then does the condition affect the financing for a manufactured home?
I mean, obviously, it's probably like any other traditional, conventional, FHA, financing type situation. We do an appraisal on this, and if there's anything that's ever called out safety and health-wise, mold or something leaking, water stains in a ceiling, that will probably get called out and will need to be repaired before we can close. But as far as things are habitable, and it's a lot of times these are dated, but that doesn't mean it's a bad house or it's not habitable. So as long as it's in decent shape, there shouldn't be any problems.
You mentioned something earlier about a small property tax. How does that work versus like the HUD, like a registration fee, or if you're familiar with that at all?
Not 100% familiar with that, but with the property taxes, it seems to kind of vary from location to location. They've all been very small because you're not paying traditional property taxes like you would on a normal purchase. So what I've seen, they normally come back, they're normally less than $1,000 a year, if that. So I always kind of estimate around $100 a month when I give someone a quote just for worst case scenario, but it's usually less.
I love it. Okay, now what documents does somebody need to bring in when getting qualified for a manufactured home?
Your standard documents like your 2 years W-2s, last 2 paycheck stubs, last 2 months bank statements, driver's license, and your social security card. We can use gift for down payment. I've even been able to use cash as down payments as long as we get a nice detailed letter of explanation stating, why we had this money saved elsewhere. As long as it makes sense, we can use that. So like I said earlier, very flexible with a lot of these issues that sometimes are problems with traditional loans.
Yeah. Okay. What about somebody gets qualified for an FHA or a VA loan? Can they use that for a manufactured home on Lease-Land?
Not on these. So as far as I know, FHA, VA, conventional, they will not touch these loans and these products in space rent situations.
Yeah, which is good that they come to you because you can help them qualify for both, basically, if they wanted to. You can get them qualified for an FHA, VA loan and a manufactured home. And what we've done quite frequently whenever somebody reaches out to us, it's like, look, get qualified for both. Because once you factor in the reduced term, a 20-year term or a 25-year term, and depending on what the space rent, your monthly payment may come out a lot closer to what it would maybe for a condo or a townhouse as well too. So if you're able to qualify for both, you're able to have both scenarios, and then you get to decide, okay, which one do I want to move forward with?
Yeah, 100%. Especially when you're looking at some of those higher space rents in the $2,000 range, $1,800 a month range. If you find something that has $300 HOA dues or $400 HOA dues when in the regular tax rate, In most cases, you can get a lot more bang for the buck buying a condo or a townhouse in some cases.
Yeah. What's the number one reason you see people get rejected for manufactured home loans?
Sometimes they just think it's too easy. They think, oh, it's a $10 purchase price. should qualify for this, no problem. You still have to have solid income. You have to have the employment history that we can document. You need to have the down payment. But sometimes just people think it's too easy to qualify, and when it is like a traditional loan, you have to kind of have decent credit, put your income on paper, and qualify.
What about insurance? How does that work on manufactured homes?
Just like it's very similar to your traditional financing. The main bank that I work with on these, they actually will send all of our buyers a quote that they have, that the insurance company, and 95% of them actually go with that quote. It's super solid, specialized towards, but people are free to shop around and get their own quote and use that. It's around $1,200 a year in most cases.
I love it. Got it. If somebody wants the best financing terms for a manufactured home, what are some rules of thumb?
Obviously, credit's number one. You want to have a good credit score. Down payment doesn't have play that much of a role when it comes to our interest rates. People sweat it sometimes. I don't have 20% down, or I only have 10% down. Don't worry about it. And also with these programs too, when you're putting less than 20% down, these don't have PMI. There's no PMI on these loans. So sometimes in a traditional financing situation, when you're putting down less than 20%, there's going to be PMI, which is private mortgage insurance. On these, there is none. So don't worry about putting down the full 20%. No problem doing the 5 or 10% down.
I love it. Good. Any trends that you're seeing with mobile home or manufactured home financing at the present moment?
Just that I think more people are looking at them now than in the past. With prices going up, people are looking at some of these newer mobile homes, in the last 5-10 years that are actually really modern and convenient. So I think people are kind of looking at it more often than they did in the past.
Well, I think one of the things that I think about it, personally, like if I had a choice between a condo that has common walls or a manufactured home with no common walls, I think I would choose the no common walls. If I had a choice between a condo having to drive somewhere else to park or being able to park right in front of my unit, I'd probably pick that as well too. Maybe if I was a little bit older in age and I had a 2-story condo versus a single level manufactured home, I might even consider the manufactured home. So I think for a variety of reasons, manufactured homes, mainly because of affordability, are becoming a little bit more popular, and a lot of people are just exploring that as an affordable option to be able to stay in California. Not only that, but let's say somebody's downsizing. I had a client one time, Michael, who told me, hey, look, my payment's $2,500 a month. I have $300,000 in equity. I want to stay here in California, and I want to reduce my monthly payment. The right solution was buy a manufactured home in cash. Now your space rent's $1,000, and you got to stay here in California, basically, right, and you reduce your overhead. So I think for many reasons they're becoming popular. If somebody wanted to get a hold of you or stay in touch with you, what's the best way for them to do that?
Best is always reach out via cell phone, via text or call. My phone number is 805-407-5777. Check out my website, myhomelending.com. Instagram, my_homelending. We start a conversation and get things going. It's a great way to get your foot in the door in the housing market with very little money out of pocket. Great start.
Amazing. Okay, so in today's episode, we had Michael Yates. We talked about how to finance a manufactured home on Lease-Land. We talked about down payments. We talked about credit score. We talked about land leases. We talked about park approval and a lot more. So if you've enjoyed this episode, make sure to hit that subscribe button. If you feel that this episode will be helpful, make sure to hit that share button. To Michael Yates, thank you so much. And to our viewers, until next time.
Thanks, Jose.